thought I'd be cheering when the unemployment rate went up and more people lost their jobs, and also they're getting less pay for what they're doing. So that's actually what the economy is, or what the state of the economy is right now. Why? It's because of the Fed. So the Federal Reserve, they came out this week and said they aren't going to raise rates, but they've already raised rates exponentially over the last year and a half. And if you're out there looking for a house, you know exactly what I'm talking about. But in today's video, we're going to talk about is the economic news. And remember, I went over it on Monday with you, all the data that's coming in. And I said, the Federal Reserve isn't going to move rates, and we're probably going to start seeing cracks in the foundation. Well, let me see if I was right. So the first thing we want to do is go over to the economic calendar, and here it is. Hold on, let's get out of that piece of it right there. And let's go down through here and let's discuss what came in this week and the repercussions or the results that it had on the markets, especially mortgage rates. And I think you're going to be extremely happy at the end of this video when we start going over rates. So right through here on Tuesday, we had the consumer confidence come out, and I said, this is going to be dismal. It's going to continue to drop and drop and drop. Well, it is. Last reading was 104. Now it came in at 102. All you need to know about this is it's dropping. It's getting worse, okay? So now we start looking into the data that the Federal Reserve really monitors. What data did they really monitor? Well, we have to figure out why they were created in the first place. Well, they have two mandates. Basically, they were created to control two things. One was the employment. They want full employment or maximum employment. And the other was price stability, AKA inflation. They put a pretty bad job at that in the last 2 years, but it's starting to really pay. All those rate increases that they've done starting to pay off for them right now, but it's going to start hurting me and you, the consumer. So let's get over to that data. On Wednesday, we had ADP payroll numbers come out. Now, I don't put a lot of credence in this number because they're usually way off. They're starting to really dial it in right now. So they expected 150,000 people to be basically employed over this employment cycle. Came in at 113, a little bit lower. So that started a little rally in the markets. Interest rates started coming down because of that. The next thing we had manufacturing. Manufacturing came in previously at 49, came in at 46. So that means there's less and less orders out there taking place. Then you go to the JOLT index, how many job openings there are. That's basically staying flatline right through here. Last reading was basically 9.5, we're at 9.5. Then you go down here. The Federal Reserve announced on Wednesday that they're going to keep mortgage or interest rates the same, which they did. And I predicted that at the beginning of the week. Now, here's the data that's really starting to crack the foundation and really starting to, I'll say it this way, improve the markets. Because again, the Federal Reserve, they're doing all this to curtail inflation, curtail wage growth and everything else like that. And it's starting to really work. So now we're starting to see interest rates basically plummet because there was a huge risk spread in interest rates. And I'll get to that in a second. But on just today, here's what we have out. Average hours earnings was 0.3. Came in at 0.2. So that means you and me are making a little bit less money right now. Non-farm payrolls. It was last reading came in at 297. Actually, this was revised. It was about 310,000 new people got employed. That was revised to 297. It was expected to come in this time at 180. Came in at basically half of where we were last reading. There's cracks in the foundation, folks. Unemployment rate went all the way from 3.8 to 3.9. Federal Reserve wants this at 4%. And then you're seeing the ISM manufacturing. It went from a reading of 53 to now at 51. Again, less and less things being produced. So all this is telling us is the workers out there, they're getting, the employers are getting more work out of their employees, paying them less, and more companies are letting go people and not hiring back. So that's what's going on. That's exactly what the Federal Reserve wants. So based on this data, what is going on with mortgage rates in the bond market? Well, let's get over to that. So what we follow here on the channel is basically what the mortgage bonds are doing, because that gives us basically a predicate of what mortgage rates are going to do. Over the last 3-4 days, rates dropped over 0.5%. 0.5%. That drop is going to continue because right here, what we're seeing right here, this is a mortgage-backed security. It's a bond that trades on Wall Street. That's yield is the biggest component of your mortgage rate. Okay, what this number is right here is the price of a bond. So as the price, all you need to know is if the price of the bond goes down, rates go up. Okay, if the price of the bond goes up, rates go down. So there's an inverse, a yin-yang effect. The bigger the number up or down, well, the bigger the adjustment. Right here, if you squint, you're going to see the prices of this bond are up 72 ticks. That means we're probably going to get another 0.25% reduction in rates. So let's get over to where rates are right now so I can give you kind of a gist of what's going on there. If you look back just 5 days ago, last time this week, rates were 8.03%, the highest we've seen in the last year, the highest we've seen in the last 20 years. Where are they now? 7.5. I'm expecting this to get to about 7.3 today, between today and Monday. So if you're out there and you locked in, you might be saying, oh, Dan, come on. If you're locked in with us, guys, we got your back. That's why we are our broker. And when I talk to you, I explain to you what we do and how we do it. So if rates go up, you're protected. If rates go down, we'll do everything we can to renegotiate your rate or maybe even possibly move your loan to another lender, because that's why we're one of the country's largest brokers. If you're out there and you're working with a preferred lender or a bank or a credit union and you locked in, you're stuck. You are stuck. It's like buying a stock. Once you bought it, you're done. So if you're out there and you're like, hey, Dan, can you help me maybe get 0.25%, maybe 0.5% off my rate? Love to help. So how you reach out to us? Right through here. So if you're either a first-time home buyer that's already locked in, you need our assistance, love to help you. Or if you're a first-time home buyer that hasn't really started this plan, but you're like, hey, Dan, rates are kind of coming down a little bit. I want to see if I can qualify. What I always say to you guys is don't disqualify yourself. Reach out to us. We'd love to help you navigate this scenario to kind of, basically I always say we're going to get you through all the landmines that you otherwise would have kind of blown up on and, help you through this whole process. How do you reach out to us? Well, there's 3 ways. One, you can hit the apply now button. That's what most people do. What it's going to do is something a little unique. It's going to ask you a few questions. The reason why we do that is we want you to assign you with a specialist on our team that's, knows exactly about the program that you're looking into. But if you're like, Dan, I need answers quick because I'm supposed to close in about 3 weeks or 4 weeks. I'm locked in. I want to see what you guys can do for me. Well, the best way to reach out to us then is scroll down through the website, and it's therateupdate.com. You're going to see all kind of blogs and tutorials and mortgage calculators. Then at the bottom of the screen, what you're going to see is right through here. You're going to see our contact number and our email. You can reach out to us at 844-775-5626, or you can email us at dan@therateupdate.com. Thanks so much for watching, guys. I hope you like this new format. If you do, please comment down below what you like, what you don't like, and some things that you'd like to see in the future. So God bless. Have a fantastic weekend. See you Monday. Bye-bye.